Around 10 years ago, the investment world was rocked by a new and disruptive idea. Some investment managers succumbed to it, while others found a way through it. This is a story about my efforts to surmount the challenge and how it led to a technology that is set to transform the way we invest. It offers asset managers a new and powerful way to package and distribute their new and existing products. It offers investors interactive access to an extensive opportunity set, greater investment precision, and better expected returns. And for innovators and entrepreneurs, it offers the chance to do something special by collaborating in one of the most exciting areas in investing. I launched my first hedge fund back in year 2000. It was based on a systematic equity market neutral strategy, trading in single stocks. And as far as I know, it was the first of its type in Europe. Like every other hedge fund, any return I made above cash was seen as alpha and attributed to manager skill. Over time, some systematic strategies became widespread, and then a bombshell. Around 2011, leading index companies and investment banks made the case that there are some strategies that are so established that the returns they generated should be seen as an alternative risk premium. And as these strategies are transparent and mechanical, they could be constructed and sold as indices. The long-only strategies were known as smart beta and the long-short risk premium. Over the next few years, these products grew exponentially, affecting the business models of many investment managers. Part of my alpha was now risk premium. Suddenly, life had got tougher for hedge fund managers like me. Now there was a new normal. And to stay relevant, hedge fund managers had to beat two benchmarks, cash and risk premium. But first, what exactly is a risk premium benchmark? We built one by drawing from the array of products out in the market. We used the most popular factor to represent each strategy. So for example, for value, we used earnings yield. And for price momentum, we used the past 12 months performance. We have done this for 5 of the most established strategies. We have implemented them using the most conventional methodologies reflecting common practice to create a set of liquid indices. A benchmark such as this is now our new normal, the base case. So how do we beat indices such as these? First, by avoiding their limitations. Risk premium strategies are designed not just for performance, but also for acceptability and convenience. For example, risk premium strategies are limited to only established and conventional strategies. The total transparency they offer can lead to crowding and front-running. The high capacity they are designed for limits the investment universe. The ideas surrounding risk premia are very powerful, but they are not the limit of systematic investing. Systematic research at its core is about developing winning strategies by quantitatively replicating powerful investment ideas, esoteric if need be, and verifying their efficacy using a robust backtesting framework. And then to have an investment process that fights for every basis point at every stage of the process in order to maximize returns. Over the past 35 years, I've been building and rebuilding every aspect of my analytical framework, striving to be different, better, and systematic to beat the market. As a researcher and a trader, constantly asking the what if question and seeking answers as quickly as possible. Coding, building strategies, constructing portfolios, and trading them. From the most mundane risk premium strategies to the most sophisticated hedge fund strategies. And so, yes, risk premier strategies can be beaten by developing and adding enhanced risk premier and alpha strategies to the portfolio. But in striving to beat the risk premier challenge, I had developed something that was much more valuable. Much, much more. I had built a technology that others could use to create winning investment strategies. It was becoming increasingly clear that the value this technology could add to asset managers and investors was much greater than any hedge fund I could launch. Let me share with you briefly 3 ways. This investment process has been the source of hundreds of payoffs previously successfully traded on proprietary trading desks, hedge funds, and asset managers. Today, this application enables asset managers to leverage our investment process and the powerful backtesting engine to create new strategies of their own and take ESG stances without degrading performance. This application enables asset managers to add winning systematic methodologies quickly and cheaply. Quantamental is about combining a quantitative approach with a fundamental analysis. I developed and launched my first quantamental strategy back in 1995 for Salomon Brothers. Here too, evolved versions of this strategy were later traded on the Salomon Brothers proprietary trading desk and more recently with a large hedge fund and a large asset manager. Today's version is much more powerful. It offers buy and sell trading signals from winning systematic strategies and the related analytics, and that's very important, to enable active managers to apply a discretionary overlay to enhance the returns even further. It's a powerful methodology, highly leverageable by active managers. This application was originally designed to help me construct hedge fund strategies. The key to this is the diversification achievable from the vast array of productive and diverse payoffs made available here. Working with the underlying securities, this application has the necessary granularity to craft the simplest to the most complex strategies. Here is an example of building a simple strategy using a customized model. A portable alpha that can be owned through swaps, notes, AMCs, or managed accounts, or combined with beta and traded through direct indexing. You don't need to be able to code to build a winning hedge fund strategy with this technology. I have a prediction. I predict that this way of investing will be a significant part of the investment landscape within the next 5 years. Why? Because the transferable nature of this type of technology is set to transform investing. By offering asset managers a new and powerful way to package and distribute their new and existing products, by offering investors interactive access to an extensive opportunity set, greater investment precision, and better expected returns, and enabling innovators and entrepreneurs to do something special by collaborating in one of the most exciting areas in investing. And for my part, I'm up for the collaborating.